In today's video, we're diving into one of the most effective tools when building a diversified portfolio, and that's in the form of a global or all-world ETF. Before we get into the specifics, let's quickly discuss why a global ETF might be a good option for you. You see, as investors, it's very easy to focus on the markets that are close by to us, whether that's the FTSE 100 or the S&P 500 for example. The world is much bigger than these markets, and by limiting yourself purely to these markets, you could be missing out on growth from abroad. By investing in a global ETF, you're not just relying on the success of one particular market. Instead, you have exposure to the entire world economy. This diversification can help smooth out ups and downs of market volatility, and over the long run, it could lead to stronger returns. One of my favourite quotes comes from the Vanguard founder, John Bogle. He says, "Don't look for the needle in the haystack, just buy the haystack." This really resonates with me. A lot of people believe that investing is all about rolling the dice and trying to find the next big thing, when in reality you could just buy a small portion of the whole market and reap rewards of these different markets and sectors. This is backed up by recent advice that came out from Vanguard itself, stating that at least 20% of your overall portfolio should be invested in international stocks and bonds. However, to get full diversification benefits, consider investing around 40% of your stock allocation to international stocks. So with the scene set, let's take a deep dive into 3 of the best global ETFs. Okay, so first up we have the Vanguard FTSE All World ETF with the ticker symbols VWRP. This is the accumulation version, which means instead of paying a dividend, the dividend or company profits are automatically reinvested. As the name would suggest, this ETF tracks the FTSE All World Index, and as such tracks stocks from both developed and emerging markets worldwide. In total, this contains holdings of 3,695 companies from around the globe. Here we can see the composition of this ETF. Just under 60% of the fund is held within US companies, with Japan and the UK being in the second and third largest holdings. The remainder is fairly evenly split. If you're new to investing, it's not odd to see a large chunk of a global ETF taken up by the US market. The US is the largest economy in the world, and generally the proportions on a global ETF reflect this somewhat. Having said that, it's no surprise that many of the top 10 holdings within this ETF are from the US. I'm sure you'll recognise many of these companies such as Microsoft, Apple and Amazon. The top 10 holdings make up 21.66% of this fund. This ETF has a heavy focus on the technology sector, with financials taking the number 2 spot. The other sectors are fairly evenly split, which is good to see. Again, it's not unusual to see technology being quite a large section of this ETF. This sector has the most innovation at present, especially with the acceleration of AI. Performance within this ETF is really strong. ETFs are typically built with long-term investing in mind, so I'd always look at the 5 or 10-year returns when analysing historical performance. This ETF has returned just over 58% over the past 5 years, which works out around 12% per year, which is really good. Most investors would be really happy with these returns over the long term. Lastly, this fund has an annual fee of 0.22%, which is low, but it's not the lowest in the market. I'm going to touch upon how important this is a little later in the video. This ETF is very popular amongst many investors. Vanguard is regarded as one of the best fund providers, and this particular fund provides great diversification. But the question is, can either of these next 2 ETFs do any better? Next up, we have the INVESCO FTSE All World ETF. Again, quite a mouthful, but don't worry too much about these acronyms. Essentially, you've got INVESCO, which is the name of the provider. The FTSE All World is the index the ETF is tracking. Then you've got ETF, which means Exchange Traded Fund. And then the ACC is short for accumulation, simply meaning it doesn't pay out a dividend. Instead, any dividends are automatically reinvested. If you're new to investing, a dividend is essentially a share of the profits from the companies within the fund. The ticker symbol for this ETF is FWRG. A ticker symbol is essentially a code to easily find this ETF on platforms rather than having to search the whole title. Each publicly traded company, and also funds like this, have its own unique code. This one is a bit of a newcomer to the global ETF scene. It was only incorporated in June 2023. There's not loads of data to go off, but this ETF shows great promise. Let's have a dig into some of the details. This ETF also tracks the FTSE All-World Index, and as such tracks stocks from both developed and emerging markets worldwide. However, in this fund, it holds 2,650 stocks within it. That's around 1,000 less than the previous ETF we just covered. It's not necessarily a bad thing, but it's worth noting. Your investment is spread over almost a third less companies. When we look at the percentage split with the countries and sectors, the splits are almost identical to that of VWRP. Technology takes the top spot and is heavily weighted along with the US taking just over 60% of the exposure. Taking a look at the top 10 holdings, it's a similar picture again, but with Taiwan Semiconductor taking a slightly higher spot. It's worth noting that you can see the entire list of companies on the provider's main websites if you did want to delve a little deeper. Now when it comes to performance, it's a new fund so we don't yet have much historical data to go off. The 1-year returns are just shy of 12%. However, given its similarity to the previous ETF, I think you'd expect the 5-year returns to almost mirror that of VWRP. The key with this fund though is that the fees are just 0.15%, which is one of the lowest in the market for a global ETF. Now these might seem like really small numbers, but they can make quite a dent in your investment long term. I've run a quick example of this here. Let's presume you're looking at 2 identical funds with 12% annual growth per year. For this example, I've added in £100,000 to start and then an addition of £1,000 per month or £12,000 per year. By the end of 30 years, you can see the two totals here. On the left we have the fund with the lower fees of 0.15%, and on the right we have a fund at 0.22%. You can see that over a long period of time, the one with the slightly larger fee would have cost you around £91,376 more than the one with the lower fee. It goes to show that what seems pretty harmless at the start can really compound over time. The same goes to choosing the right platform. Always look for the ones with the lowest fees. Okay, so let's take a look at our third global ETF. This is the Vanguard FTSE All-World High Dividend Yield ETF, with the ticker symbol VHYL. This one's a little bit different and may appeal to you depending what your investment goals are. This would appeal to someone who's more focused on generating passive income rather than outright growth. As the title of this ETF suggests, this one provides a great dividend at 3.17%. So for every £10,000 invested, you could expect an annual dividend payment of around £317. This ETF has a different selection of stocks. It has less stocks within it when compared to the other two funds at just 2,031 stocks. This is because it's focused on only including stocks which pay a dividend, and not all companies pay a dividend, so they're removed from this global selection. The composition of this ETF is quite different to the other two. Where the other ETFs had 60% of their holdings within the US market, within VHYL it only makes up around 43%, with the other countries being much more evenly spread. Depending on your feelings towards the US market, this could be seen as a good or a bad thing depending who you are. If you're looking for outright diversification and possibly less risk, I'd say this is better than the other two funds, as you have less of your investment riding on the success of the US market alone. The flip side of this is that you may not be exposed to as greater gains by cutting out more of the biggest market. Moving on to the top 10 holdings, you can see this is completely unlike the other two. The top 10 here only make up around 14% of the overall fund, again adding to further diversification. The companies themselves aren't all large cap US tech stocks. We have big players from all over the world within this top 10 from all different sectors. I'm sure you'll recognise a lot of these household names. As you'd expect, the split across the sectors is also different. It's no longer dominated by big tech companies. With this fund, it's much more evenly split, with the largest sector being in financials. Looking at the historical performance, the 5-year returns are just under 40%, so around 8% growth per year, which is including the annual dividends. Given that the holdings and the sectors are much more evenly split within this fund, it's considered less risky and less volatile when compared to the other two funds. The only drawback of this fund is that the fee is 0.29%, which is the highest of these three, but it's to be expected with such a high dividend. So what have we learned here? These are 3 great ETFs, but which is best for you? For me, both VWRP and FWRG are very similar, and I imagine the results would be pretty much identical in the long term. But for me, FWRG has the lower fee, so that's the one I'd go for if outright growth is what I'm looking for. So where does that leave the high dividend yielding VHYL? Well, that purely comes down to what your investing goals are. If you're looking for more passive income and the dividends is the appealing part for you, then this is probably the one to go for. I think a lot of this comes down to your age too. If you're in your 20s and looking to build wealth over the long run, then I'd opt for FWRG. But if you're a little later in your investment journey and slightly older, you may be now looking for income off your investments. If that's the case, then VHYL is the way I'd go. I also think VHYL offers more diversification, so if you're slightly more risk averse, this may be a factor as well. Whichever you choose, the key with these funds is to invest regularly. Set aside a portion of your income to investing every month and let it compound year after year. Since these global ETFs do a lot of the hard work for you, they're somewhat of a set and forget type of investment. They offer a balanced all-in-one solution which can provide long-term growth whilst minimising risk. If you're new to investing, these ETFs can be bought on many platforms. However, some of the best and lowest cost options are Trading 212, Free Trade and Invest Engine. Just make sure when you're opening an account, you opt for their ISA option, as this will shelter any capital gains from taxation. If you're interested in learning how these investments could grow over the long term, you might find my video on compound interest quite useful. I'll leave the link to this somewhere up here. I'd be really interested to hear your thoughts on this video. If you're someone who's currently investing in a global ETF, let me know which one you've chosen and why. If you've enjoyed this content, do like and subscribe, it really helps the channel in these early stages. Thank you for watching, and I'll see you in the next one.